Today, we'll summarize the book, Trading in the Zone, by Markdouglas, one of the best books on trading psychology ever written. This book is based on Douglas's experience as a trader and a coach, and it reveals the secrets of how successful traders think and act differently from most other traders. The book explains why most traders fail to achieve consistent results, and how you can overcome the mental obstacles that prevent you from reaching your full potential as a trader. The book is divided into 5 parts. 1. Part 1, The Road to Success. 2. Part 2, The Lure and Dangers of Trading. 3. Part 3, Taking Responsibility. 4. Part 4, Consistent Winners Think Differently. 5. Part 5, The Dynamics of Perception. In this video, I will give you an overview of each part and highlight the key takeaways that you can apply to your own trading. Part 1, The Road to Success. In this part, Douglas introduces the concept of trading in the zone, which he defines as a mental state that allows you to trade without fear or hesitation. Trading in the zone means being in harmony with the market, accepting its unpredictability, and acting with confidence and clarity. Douglas argues that most traders are not in the zone because they have unrealistic expectations about the market. They think that they can predict or control what will happen next, or that they can find a perfect system or strategy that will guarantee success. They also have emotional attachments to their trades, such as wanting to be right, wanting to make money, or wanting to avoid losses. These expectations and emotions create psychological barriers that interfere with their ability to trade objectively and rationally. They cause traders to make mistakes such as overtrading, undertrading, cutting profits short, letting losses run, or deviating from their plan. To overcome these barriers, Douglas says that traders need to change their mindset and attitude towards trading. They need to understand that 1. Trading is a game of probabilities. No one can know for sure what will happen next in the market. The only thing you can control is yourself and your actions. 2. Trading is a performance skill. It requires practice, discipline, and constant improvement. You need to develop a consistent method that suits your personality and goals. 3. Trading is a mental challenge. It tests your ability to deal with uncertainty, risk, and stress. 3. You need to cultivate a positive and confident mindset that will help you cope with any situation. By adopting these principles, Douglas says that you can start to trade in the zone and achieve consistent results. Part 2, The Lure and Dangers of Trading. In this part, Douglas explains why trading is so attractive and addictive for many people. He says that trading offers us an opportunity to express ourselves creatively, intellectually, emotionally, and financially. It also gives us a sense of freedom, adventure, excitement, and challenge. However, trading also has its dangers. It exposes us to our deepest fears and insecurities. It confronts us with our limitations and flaws. It triggers our emotional reactions such as greed, fear, anger, frustration, regret, guilt, or shame. These emotions can cloud our judgment and impair our performance. They can also create negative feedback loops that reinforce our negative beliefs and behaviors. For example, 1. If you are afraid of losing money or being wrong, you may avoid taking risks or entering trades that have a high probability of success. 2. If you are greedy or impatient for profits, you may overtrade or exit trades too early or too late. 3. If you are angry or frustrated with yourself or the market, you may revenge trade or break your rules. 4. If you are regretful or guilty about your past mistakes or missed opportunities, you may dwell on them or try to make up for them. To avoid these pitfalls, Douglas says that traders need to learn how to manage their emotions and impulses. They need to develop a strong sense of self-discipline and self-control. They also need to detach themselves from the outcome of each trade and focus on the process instead. Part 3, Taking Responsibility. In this part, Douglas emphasizes the importance of taking responsibility for your trading results. He says that many traders blame external factors such as the market, the news, the brokers, the indicators, or the systems for their failures. They also attribute their successes to luck or coincidence. This attitude prevents them from learning from their experiences and improving their skills. It also makes them feel powerless and helpless in the face of uncertainty and volatility. Douglas says that traders need to realize that they are the ones who create their own reality. They are the ones who choose what to trade, when to trade, how to trade, and how to respond to the market. They are the ones who determine their own success or failure. By taking responsibility, Douglas says that traders can gain more confidence and control over their trading. They can also learn from their mistakes and successes, and adjust their strategies accordingly. Part 4. Consistent winners think differently. In this part, Douglas reveals the secrets of how consistent winners think and act differently from most other traders. He says that consistent winners have a set of beliefs and attitudes that enable them to trade in the zone. These include: 1. They believe that anything can happen in the market. They don't have any preconceived notions or biases about what will happen next. They are open-minded and flexible. 2. They don't need to know what will happen next in order to make money. They don't rely on predictions or forecasts. They rely on probabilities and edge. 3. They know that every moment in the market is unique. They don't assume that the past will repeat itself or that the future will follow a pattern. They treat each trade as a new opportunity. 4. They don't attach any significance or meaning to any one trade. They don't get emotionally involved with their trades. They view each trade as just one of many in a series of trades. 5. They have a positive expectancy about their trading system. 5. They trust their system and follow it consistently. They don't second-guess or doubt themselves. 6. They act without fear or hesitation. They execute their trades with confidence and clarity. They don't let fear stop them from taking action or hesitation cause them to miss opportunities. 7. They accept the risk of every trade. They know that every trade has a potential for loss as well as profit. They are willing to take calculated risks and accept the consequences. 8. They accept the outcome of every trade. They know that they can't control the outcome of any trade. 8. They are prepared for any result and move on without regret. By adopting these beliefs and attitudes, Douglas says that you can become a consistent winner in trading. Part 5. The dynamics of perception. In this part, Douglas explains how our perception affects our trading performance. He says that our perception is influenced by our beliefs, expectations, memories, emotions, and experiences. These factors shape how we see ourselves, the market, and our relationship with the market. Douglas says that our perception can either help us or hinder us in trading. It can either enhance our ability to trade in the zone or impair it. For example, 1. If we have positive beliefs about ourselves and our trading system, we will perceive the market as an opportunity to express our skills and talents. 2. If we have negative beliefs about ourselves and our trading system, we will perceive the market as a threat to our self-esteem and security. 3. If we have realistic expectations about the market, we will perceive it as a dynamic and unpredictable environment that requires constant adaptation and learning. 4. If we have unrealistic expectations about the market, we will perceive it as a static and predictable environment that requires rigid rules and formulas. 5. If we have clear memories of our past trades, we will perceive them as valuable feedback and lessons for improvement. 6. If we have distorted memories of our past trades, we will perceive them as sources of pain or pleasure that influence our future decisions. 7. If we have positive emotions about our trading, we will perceive it as a fun and rewarding activity that motivates us to perform better. 8. If we have negative emotions about our trading, we will perceive it as a stressful and frustrating activity that undermines our performance. To improve our perception, Douglas says that we need to be aware of how these factors affect us and how we can change them if necessary. He suggests some techniques such as: 1. Affirmations. repeating positive statements to yourself that reinforce your desired beliefs and attitudes. 2. Visualization. Imagining yourself trading successfully in various scenarios and situations. 3. Meditation. Practicing mindfulness and relaxation techniques that calm your mind and body. 4. Journaling. Writing down your thoughts and feelings about your trading experiences and reviewing them regularly. By using these techniques, Douglas says that you can enhance your perception and trade in the zone more often. That's it for this. Thank you. See you again soon with something new and interesting.